Hey, what's going on, you guys? It's Marcos. In this video, I'm going to be showing you 3 simple and easy ways that you can take advantage right now in 2021 to pay off your mortgage as fast as possible. And really, guys, the 3 strategies that I'm going to be showing you are really simple. You should be able to just follow what I'm going to be showing you and apply it right now into your mortgage so that you can complete your mortgage freedom a lot faster. To me, being completely mortgage free should be one of the biggest accomplishments for anybody out there. And really, it is very possible. You might not be able to think right now that it is possible to pay off your mortgage because, mortgages just have a really big balance. But, once you start working the math together, and if you are a disciplined person, then that's going to help you guys a whole lot. So anyways, I'm going to show you real quick these 3 simple ways that I'm talking about so that you can start applying them right now in 2021. All right, so the first strategy that I'm going to show you is the biweekly mortgage payment. And this is definitely the easiest thing that you can do because literally you don't have to change pretty much anything on what you're already doing, except that you're just going to change the strategy of the monthly payment. So basically, the whole idea of the biweekly mortgage payment is that you're splitting your regular mortgage payment in 2 payments per month, which in turn turns out to about 26 payments throughout the year, which if you divide 26 payments by 2, then you end up paying 13 payments throughout the year. So remember, you're making 12 mortgage payments throughout the year, 1 every single month, but with a biweekly payment, just because you're paying 26 payments, you're actually paying 13 months. And so basically, it just comes out with you adding 1 additional payment a year, which is going to go always towards the principal. So I'm going to show you this example real quick so you can understand what I'm talking about. Okay, so I'm really going to assume that you have a $400,000 mortgage and you have a 3.5% interest rate on a 30-year fixed loan, just to make things really simple, which is really going to make your principal and interest be $1,796 every single month. Okay. And so basically what the biweekly payment says is that you're just going to take your principal interest payment, you're going to divide it by 2, and you're going to make the first half of the payment at the first of the month, and then the second half of the payment on the 15th of the month. So basically 2 weeks, right? So you're going to be making a payment of $898 on the first and one other payment of $898 on the 15th. And that's basically going to be your biweekly payment. Now, if you do this times 26, you would end up paying a total of $23,348 throughout the whole year, right? So that's basically 13 months. Versus if you just take this monthly payment of $1,796 times 12, you will only pay $21,554. Now, the difference between the 2 numbers is literally $1,796 a month. So that's basically the whole biweekly payment schedule on getting a mortgage paid off. And now, so basically what does this really achieve is that it's going to help you pay off your home in about 4.5 years sooner on a 30-year fixed mortgage. Now, if you do this on a 15-year loan, you could do a biweekly payment on a 15-year loan, a 20-year loan, whatever term you have going on right now. It's not going to be the same. This works on a 30-year fixed loan where you pay off the mortgage 4 years sooner. On a 15-year loan, if you have a 15-year mortgage, you will pay it off in about 2.5 years sooner. So it's not the same for every single term, but the biweekly monthly payment schedule is the simplest thing that you can do. You literally don't have to do anything except just pretty much figure out how to do it on your servicer. You know what I mean? Like just go on your online mortgage account and figure out how to do the biweekly payment. Now, if you cannot do the 2 times a month, then the next thing that I will suggest you to do would be to just simply add a 13th payment on the year, anytime on the year. It doesn't matter if it's in January, it doesn't matter if it's in March, it doesn't matter if it's, in December. A lot of my clients, what they do is if they have a tax refund, they would just take that tax refund and apply it towards the mortgage as an additional payment. That's really smart to do because literally, so as long as you just make 13 payments in the year, you're basically achieving the biweekly payment schedule. So just adding 1 more payment in the year will probably be easier for you. Now, the next example is going to take a little bit more work. And that's basically because you're going to be refinancing into a lower term. Now, a lot of people get this wrong because a lot of people think that getting into a lower term means that they actually just have to do a 15-year refinance where, you're bringing down the term so much that it makes your monthly payment go up by quite a lot. And a lot of people just simply can't take on such a higher payment on a 15-year loan. But guys, there are other options out there. You don't have to do a 15-year refinance. or 15-year term to pay your loan sooner. You can do 25 years. You can do 20 years. Yes, you can definitely get down to 15 and you can even get down to 10. But maybe if your monthly budget doesn't allow you to actually be able to afford a 15-year monthly payment without being, too uncomfortable, then you should be looking into maybe a 20-year. So I'm going to show you guys this example real quick. Now, I have the same mortgage as before, where basically I owe $400,000 at 3.5% interest rate. And basically over the whole 30 years, I have a total payment, between principal and interest of $646,624. That's basically if you pay off the loan in 30 years, which to you, it should mean about $246,624 just on interest payment alone. And that's the crazy thing, because just $246,000 on interest is a whole lot of money. But what if you do a 20-year refinance? And so basically the numbers work out this way, where maybe you get down to a lower interest rate. That will be one of the reasons why you may want to refi, is maybe you get down to a better rate, right? So I'm just going to assume that you can do a 20-year refinance at 3% interest rate, and your principal interest payment jumps up to $22.18. So that's probably about $400 a month, over what you're paying on a 30-year mortgage. And basically, the whole goal of this is not just to pay off the loan 10 years sooner, but also pay off, even less in interest. And the difference is a lot, because you will be paying about $132,000 on interest payments over the 20 years. So what does that really mean to you in terms of savings? Well, it actually is going to mean somewhere around $114,000 worth of savings just on interest payments alone. And that's really why you want to look into a lower term refinance, especially if you're able to get down to a lower interest rate. Honestly, if you're not getting to a lower interest rate, or maybe you're, eliminating principal, PMI, the private mortgage insurance, then it doesn't really make too much sense to do a refinance into a lower term, because you want to get some savings based on the interest and based on the fact that you don't have to pay any mortgage insurance premiums such as PMI or the MIP for the FHA mortgage insurance, right? All right, guys. So the last example I'm going to give you is what I call the debt consolidation refinance and reinvesting back into your property. Now, this one does take a little bit more effort, but if you have other debts such as credit cards or personal loans, student loans, and things like that, believe me, this one is going to be really cool for you, because I'm going to show you how, paying off everything that you owe through your mortgage is going to help you get financially free even faster. But once again, guys, you do have to be very, very disciplined with your finances. You can't be a knucklehead using your equity to basically buy Ferraris or Lambos, okay? So let me show you guys an example that is really common, that I see all the time. And this one is really going to make a lot of sense for you, okay? All right, so I'm going to assume that I have a mortgage of $400,000, basically the same thing that I've been talking about, before, 3.5% interest rate with my principal interest payment at $17.96 every single month. But now I'm going to assume that I'm paying PMI, and maybe when you bought the house, you didn't have the 20% down. So you did like maybe a 3, 5, 10% down payment, but now you have enough equity in the property where you don't have to carry the PMI anymore. Your home's value went up like crazy, just like how everybody's home's value has been going up like crazy pretty much anywhere you stand in this country, right? So maybe you don't have to have the PMI anymore. You have a lot of equity in the property. But anyways, between the principal and interest and the PMI, you're paying a total of $2,022 every single month. But you have other debts, right? So you have all these things over here. So I'm going to assume that you may have a credit card for $20,000 and it has a monthly payment of $400 every single month. And maybe you even pay a little bit more just to knock it off, but paying off a $20,000 credit card can get pretty damn hard sometimes, right? But you also have a personal loan for $25,000 and your monthly payment is $500 a month. So basically in other debts, you're paying $900 a month. So between the mortgage payment, so we're going to call this mortgage at $2,022, and then the other debts, so you basically your unsecured stuff that also has higher interest rates, APR, and all that good stuff, or really bad stuff, is $900 every single month. So your total is $2,000. I'm just going to go ahead and run this off to $3,000 a month. That's basically what you're paying, okay? Now, what if you did a refinance where you are combining all these things? And by the way, guys, a couple things before I even show you how this thing, how this whole stuff looks like. But when you take out your equity from your property, it is completely tax-free. You don't have to pay taxes on it. So it is your equity. You can do whatever you want with it. Okay. You don't have to pay taxes. You don't have to, tell anybody how you're going to use your equity or anything like that. Just don't use it for illegal activities. We're using this just to pay off your stuff, right? By the way, not financial advice. This is just me showing you an example, even though I am a loan officer. And if you have more questions, links at the bottom where you can actually apply if you want to. But anyways, I'm going to show you guys how this whole reinvesting your savings is going to look like. So we're going to call this the refi option with basically, we can call it cash out, we can call it debt consolidation. It's basically the same thing. And now instead of having one mortgage and other loans or credit cards or whatever, now we're going to have a new mortgage of $445,000. And basically I just took the $400,000 here and then I just added up basically the debts that I want to pay off. Okay. So this option, we're going to call it the refi with cash out, or you can call it the refi debt consolidation, basically the same thing. But instead of now just having a $400,000 mortgage and a bunch of unsecured debt, we're just going to combine everything into one loan. So basically now you're going to have a new loan of $445,000, and say that you're going to refinance, obviously, and you're going to get the same interest rate, 3.5% on a 30-year fixed. But now you don't have to carry the PMI. So really just between principal and interest, you will have a total payment of roughly, we're just going to call it $2,000 a month, even though it's about $1,997, $1,998. So you have basically taken out a new loan and you pretty much you have cash flow. Now you're cash flowing pretty much $900 every single month, right? Because you won't have to pay off, you have to pay this stuff separately. Okay. Everything's being combined here into the mortgage. So you're saving $900 a month. So what if you actually took the $2,000 a month, which is now your new payment, right? And then you added the $900, but now you're going to add the $900 on top of the mortgage payment. So you're basically prepaying the mortgage. I'm going to show you what that looks like. So instead of making this monthly payment, you are going to make, let me put this right here, a $2,900 monthly payment. Okay. So you are not going to change anything about your lifestyle. You're still going to assume that you have the unsecured debt, but you're going to take the $900 a month and then you're going to put them back into the mortgage. Okay, guys. And just by doing that, you would be having the loan paid off in basically 17 years. All right. So by you paying $2,900 a month, every single month, you'll have cut 13 years on your loan, and the monthly savings will be not the monthly savings, but the actual savings over the life of the loan will be pretty crazy. And that will definitely help you guys pay off the loan faster. Now, once again, that strategy is if you are actually very disciplined with how you handle your money, because one of the things that a lot of people do wrong is that they would pay off the debt, but now that they're pocketing, $900 every single month, now they're just using that money and basically spending it on other stupid stuff that they shouldn't. Whereas you should be putting it back into the loan so that you can knock out the principal sooner. Okay. So even though I'm just saying, you're going to be using your house as an ATM, just be sure to sort of replenish that ATM as much as you can. This makes sense. Now you could obviously use the money that you're going to be saving for other things. If you have other stuff coming up and you don't want to take out any credit card debt, then you can definitely do something like this. But it definitely helps a lot of people who may want to pay off their mortgage, but obviously having unsecured debt just sucks and it eats up a lot of your income. So that's a pretty amazing option. And then you can also stack up this option to the biweekly mortgage payment, right? So you, instead of making a $2,900 a month, you can cut that in half and make, I don't know what that is, $1,800, $1,900 a month payment or whatever the monthly payment would be, twice every single month. And then obviously that'll help you cut off a few more years on the mortgage. Okay. You could obviously also even stack it up even more. If you are saving the money and you feel like you're not confident enough that you're going to take the savings and reinvest them back into the mortgage, then consider doing a 25-year refinance or 20, or even down to 15 if you can afford the monthly payments. But that's basically it, guys. 3 different strategies that I actually use these on a daily basis when I'm showing some of my clients strategies to pay off the loans. These are really easy to follow. And then in another video, I'm actually going to show you how to pay off your loan faster by using HELOCs and by using other types of loan programs out there. But these are 3 different really easy options that you should be thinking about if you haven't implemented any of these. And goes without saying, one other option would be just keep adding more towards your monthly payment. So if you have an additional $100 every single month that you're not doing anything with, consider just throwing it into the mortgage. It's always going to go towards principal. Remember, every single payment over whatever your minimum monthly payment is going to go towards the principal payment. And you may or may not have to tell the lender to throw it towards the principal. So keep that in mind. If you guys found the video helpful, make sure that you give it a like, subscribe to the channel. Helps the whole YouTube algorithm. Guys, I'm trying to grow over here, okay? But not just trying to grow, I'm actually just trying to give you guys as much information as possible so that you can make a really good financial decision with your mortgage, with your house, with your life. And if you actually found this video also helpful, make sure to tag somebody, share it on Facebook, share it on whatever you feel like will help other people as well to, help them in their lifestyle too. Once again, guys, thank you for watching, and I will see you in the next video. Goodbye for now.